Hi, everyone. Thanks so much for joining. This is our Fed special. We've got probably the highlight of the year so far, which is the Fed September meeting. These in the past have come up with big surprises. If you go back to 2024, that's when we got that 50 basis point increase from the Federal Reserve, totally unexpected. Cut back in September 2024. Will we get the same this time? Well, let's dive straight into the charts. As usual, I'm sitting there and I'm starting with the World Equity Index chart, as you can see here. If you follow my pointers, this is live on Tuesday. This is European indices Tuesday morning, and Europe, the risk sentiment is off a little bit, but to be honest, the declines are fairly minimal. We're seeing a bit of a sell-off in Euro stocks, down 0.15%, sorry, and a near 0.3% decline in the FTSE 100. That's due to some company-specific factors. Haleon and EasyJet both got downgraded. But if we go up, this is the US market. Now, it's not open on Tuesday yet, but as you can see, some big chunky gains, particularly for the NASDAQ, up nearly 1% at the start of the week, up 2.5% already over the last 5 sessions. It's really rallied into this. At the start of the week, we got record highs for the S&P 500. So we are seeing a really positive risk sentiment as we lead up to this Fed meeting. So what should we expect? Let's take a look at the federal funds futures market. Now, this looks like a very complicated chart, but trust me, it's really not. It just shows market-based expectations for US interest rates. So hike, cut, if you follow my pointer here, you'll see that the expectations of a cut, we know it's a cut because it's got a minus in front of it, is 104.8%. So what does that actually mean? It means that we're fully priced for a cut. There is a 100% chance of a 25 basis point cut and a very small 4% chance of a 50 basis point cut. Now, that's one thing that we will know tomorrow at about 7 o'clock London time. So as you can see here, we've really scaled back where we're expecting interest rates to go. So a lot of pricing in of that rate cut over the last few weeks, and that's obviously been reflected in a much stronger S&P 500 and a weaker dollar, which we'll talk about in a moment. But looking forward, we're actually really interested, if you go down to this bar chart at the bottom here, about this kind of real nice curve, downward facing curve. Look at this. Now, by the January 2027, the market is pricing in just under 6 cuts. So after tomorrow, that will be the 5 or 4 cuts for the rest of the next year and 3 months. So by the end of this year, we're looking at interest rates at 3.64%. So we've pretty much got consecutive rate cuts for the rest of this year. This is what the market expects. And then we've got a real rapid pace of interest rates over 2026 as well. Now, why is that significant? Let me show you. So let's go back to the dot plot. You might remember that every 3 months, the Federal Reserve update this document. It is incredibly important. This is from the June meeting, because it gives you, the FOMC members themselves, they give you their expectations of where they think interest rates will be. So in June, the average or the median estimate for interest rates for 2025 as a whole was 3.88%. That fell to 3.6% at the end of 2026. And then further out the curve, it falls to 3.3%. So as you can see, there is a decent number of people expecting higher rates than that, or FOMC members expecting higher members than that. But this is the median. So this is kind of what we work with. But 3.3% is where the market expected rates to be at the end of 2026. Let's take a look at what the market's expecting, 2.9%. So a massive difference in expectations, about double the number of rate cuts expected by the market compared to what the Fed expected back in June. So what we're going to be looking at is if the Federal Reserve is actually going to ratify what the market is thinking, then we'd expect these medians. So if you follow so this green line, we'd expect it to naturally fall lower. So naturally to slope down more downwards really, and for rates to fall somewhere middle here, to end kind of 2027 somewhere middle here. So a sharp decline in where they think interest rates will be over the next couple of years. So that's been absolutely huge. As we've seen that increase in market-based interest rate cut expectations, the S&P 500 has absolutely surged. I mean, just look at this. Beautiful uptrend, classic uptrend actually, from that low in April, and it's just continued to gain momentum there, and we're seeing a really nice strong move higher through September as well. So we're really rallying into this meeting. Futures, as we lead up to this meeting, are expected another increase, but we expect the market to be very, very quiet over the next little while. But let me just draw your attention to these moving averages, the 50, the 100 and the 200-day. We're well above those levels now, so that really suggests that momentum is to the upside. It also suggests an element of fragility. Obviously, if the Federal Reserve if they push back on the market narrative and don't signal that all those rate cuts are coming, although we do think they will cut rates tomorrow because that's pretty much baked in, and they can't surprise the market that much, not in this current environment. But if they push back on that narrative, and there are some people really urging them to do this, because obviously there's a lot of pressure from Donald Trump and the White House to cut interest rates. But if they push back on that narrative, especially for rate cuts in the first quarter of 2026, that could leave US stocks in particular very, very vulnerable. Now, I want to show you this chart. This chart shows you the S&P 500, which is the white line on the chart. It shows you the Russell 2000 and the equal weighted S&P 500, which is the green line on the chart. So the equal weighted strips out the impact of those mega cap tech companies. Now the highlighted purple chart here, lilac line here, is the Magnificent Seven. So as you can see, what has been driving the S&P 500 is those tech stocks, particularly in the last couple of weeks. It's been Oracle, it's been Tesla, and it's also been some of the other less well-known tech names. But tech has really been to the forefront. Alphabet as well. Yesterday, on Monday at the start of the week, Alphabet became the third $3 trillion market cap company in the US. Nvidia's had its own little bit of problems, but the Magnificent Seven and those mega cap tech stocks are really leading this higher. And then everything else is kind of on the doldrums. So they're not all being lifted together. This rally has been absolutely driven by tech and by expectations of rate cuts. So if we get those rate cuts reduced, then we could see an inverse move basically in the Magnificent Seven and in the overall S&P 500. So that is definitely something to watch out for. Now, this is the dollar index. So the dollar index, as you can see, is kind of breaking down. So we were stuck in a very low kind of range here, but it has broken below the bottom of that range of its summer August range. And we're now looking like we're going to try and target that July low, so that early July low, which came in at 96.37. We're currently trading just above 97, but it's been very weak. As you can see, the complete inverse of what we're seeing in the S&P 500. We've seen a massive decline in the dollar index. Again, so that's the dollar against its largest basket of trading partners, and it's well below its moving averages as well, which suggests momentum to the downside. If we just take a little bit of a look, since the last Fed meeting, again we've seen the dollar make some gains against the yen and the Canadian dollar, but by and large it's really lost a lot of steam against the euro, against the Swiss franc, and even against the pound, and the pound has its own worries there. So that's the key thing to watch out for. I want to show you gold as well. Sorry, just as the S&P 500 has rallied to record highs, so has the gold price, which reached a fresh record on Tuesday morning at just below that 3,700 level. A lot of people now talking that if the Fed does signal that rates are going to be cut very sharply, that's going to unleash a wave of inflation in the US economy and probably the global economy. And gold is your ultimate inflation hedge. So people were piling into gold. And as you can see, since mid-August, since the Fed has really switched focus to the labor market and the weakening in the labor market, we have seen just an almost parabolic rise there in the gold price. It's broken above recent ranges and is just making fresh record highs every single day. So very, very positive there. And overall, obviously the Federal Reserve is going to be the absolute key for this week. We're expecting, as I said, that 25 basis point cut, but it's what they do next. That's going to be what drives markets going forward. But thanks so much for joining, and we'll speak soon.